It's a rough time to be a first home buyer, especially if you're trying to save for a deposit.
We're seeing unprecedented growth in house prices, which means every month, every week, and at the moment it seems like every day, the amount of money you need to save up for your deposit gets higher and higher.
Which makes it that much harder to get your first step up on the property ladder.
Yeah, here's a quick example. If you're on a median household income of $89,000 and you've been saving 20% of your take-home pay for the last 12 months, you would have saved just over $13,000.
Meanwhile, the median house price in Brisbane has increased from $600,000 to $678,000 in the same period.
And in Sydney, it's increased from around $1.1 million to $1.4 million.
So in Brisbane, your minimum deposit has gone up by $6,258.
And in Sydney, it's gone up by $24,000. In Brisbane, the property market increases have basically halved your purchasing power ability because your savings proportionally has gone down. And in Sydney, you've actually gone backwards.
If house prices continue in their current trend, buying a house in Sydney will be literally unaffordable for anyone on a medium household income.
And this has got plenty of first home buyers asking the question, should I even buy? Or should I just invest my money instead?
In today's video, we're going to answer that exact question. Specifically, we're going to give you an overview of the pros and cons of buying a home to live in versus investing the money elsewhere. We'll cover the three main options: buying a home to live in, investing in the stock market, or investing in a property elsewhere.
It's going to be interesting to see which option is going to be better for you.
And before we start this video, if you find it helpful in any way, do me a little favor and hit that like button below or leave a comment for the YouTube algorithm. Just a little gesture like that can make a huge difference to the channel. And if you haven't already, please hit that subscribe button. Thanks you guys, it really means a lot. So let's dive in.
And before we start, we want to confirm that this video is general advice only. If you want specific advice for your financial situation, contact a financial planner or a professional.
First, let's take a look at a study by Ernst & Young. In 2019, Ernst & Young did a study on housing affordability to see whether you'd be better off buying a home to live in or investing in the stock market. They looked at a hypothetical scenario where two home seekers with the same starting capital equal to 20% of the average unit price at the time. One of them invested in buying a home with a lend of 80% of the purchase price.
The other person rented out a comparable dwelling and purchased an ASX 200 index fund with a margin loan at 50%. The renter continued to invest their ongoing savings in housing costs because it typically costs you more to own a home than rent it.
They compared a 10-year period of 43 local government areas in Sydney between 1994 and 2017.
In this comparison, 62% of the time, people were better off financially if they rented and kept investing in the ASX 200. But, and this is a pretty big but, in this scenario, the renter is using a margin loan for investment. And in doing so, they were taking on a risk profile that's a lot higher than most people would be comfortable with. Removing the leverage actually shifts the results back in favor of the homeowner.
So it appears at first glance that buying a home will make you better off financially than renting and investing.
But that's not the full story. Comparing buying a home to live in and investing in the stock market is not comparing apples with apples.
Given the price of properties at the moment, it's more like comparing apples to caviar.
Yeah, there's no point in directly comparing buying a home to live in with investing if you don't actually have a deposit saved up. So the real question is, what should you do with your money if you can't afford to buy a home to live in? If you're in this situation, realistically, you've got three options. Firstly, you could try putting your savings for your deposit into a regular savings account, the normal way of doing it.
The second is invest your savings in the stock market while saving up.
Or the third is potentially investing in property somewhere cheaper and rent where you want to live. They call it reinvesting.
Let's take a look at each option. Saving for a deposit the regular way. Saving for a deposit the normal way is a safe option. All you need to do is keep slogging away and cut out as many costs as possible and diligently put those savings in your bank account.
And eventually you'd hope that you'd be able to afford the deposit for your home. But as we've seen in the last 18 months, that might not be enough. When the property market's outpacing your ability to save, as it has in Sydney, you might only find yourself falling further and further behind.
And to add insult to injury, inflation will slowly eat away at your purchasing power of your money.
Yeah, interest rates are at rock bottom at the moment, which is great if you own a home, but not helpful if you're trying to grow your savings. The ultimate strategy would be to invest that money while you're saving up. Using your deposit savings for investment is one way that you can keep up with rising house prices.
Australian shares have averaged an 8.8% return over the last 20 years, which is a lot higher than what you can get from your savings account. The highest rate for savings at the moment is just over 1%.
Yeah, and to get that rate, you're going to need to satisfy a lot of conditions. Sometimes you've got to put a minimum amount of savings in a month. Sometimes there's a cap on the maximum amount you're allowed to have in that account. So it can be a lot of juggling. And there's a bit of risk and reward. And obviously with savings, it's lower risk, but the reward's lower. Fortunately, with a savings account, you can be confident that your balance will keep going up as long as you keep saving. The stock market is a lot more volatile.
The ASX 200 lost 32.4% between the 21st of February to the 20th of March in 2020. It's been heading back up ever since then, and now it's sitting just under its all-time high. But as you can see, there's no guarantee that you'll get a return.
Yeah, so it's a bit of a double-edged sword. Investing in the stock market might help you save up your deposit faster, but if there's a crash or a correction, you could actually be way worse off and lose your deposit altogether.
Taking this approach is very much a personal choice. It depends on your risk tolerance and whether you're willing to hold off on purchasing for a couple more years if the market actually heads south.
Investing in stocks while you're waiting to buy a home could be a good choice, especially if you like this Redditor. I don't see it as instead of saving up for my house, it's my long-term goal. So it's more just instead of sitting on the sidelines, scrimping a deposit through blood, sweat, and tears, hating myself just so I could sign a debt slave contract for some flammable closet designed by colorblind Ronald McDonald, I funnel all my deposit money into the stock market and am perfectly happy to let it sit even past the point of entry in the property market right now.
But if you're not willing to be patient or can't bear the risk, then there's a third option, rent vesting.
Rent vesting is where you buy a home that you can afford now, typically in a regional area as an investment, and you continue renting where you want to live. Use the cash flow and capital growth of your investment to eventually fund buying a home that you want to live in.
Rent vesting gives you added bonus of leverage. For every $1 you put in, the bank will lend you $4. You can do this with the stock market as well, but due to the volatility, there's much higher risk when things go south.
There are heaps of other benefits of rent vesting as well. Since the property is an investment, you might be able to claim deductions for your property-related expenses, and the tenants will help you pay off your mortgage faster. If you rent out a property for $400 a week, that'll net you around $20,000 a year that you can use towards your mortgage. Over time, if you invested well, the property itself, you'd hope, will grow in value. That capital growth can be massive, as we've seen in the last 18 months.
Both of these things will translate into home equity, the portion of the home that you own compared to what you owe to the lender. Once your home equity reaches high enough, you can use that amount to reinvest in property or buy a home to live in.
Yeah, alternatively, if you do have enough equity, you might want to keep it as an investment when you buy your home. So that's about it today, guys. Let us know what you think. Are you going to buy? Are you selling? Are you in the market? Are you investing in crypto? Let us know. We'd love to know. Leave a comment below.
So what's preventing you from qualifying for a home loan? Here at Hunter Galloway, we get home loans approved. So if you're living in Australia and looking for a mortgage broker, we can help. Visit us online at huntergalloway.com.au or call us on 1300 088 065 and we'll see you next time.